What's up, everyone, and welcome back to the Stocked Up Show. In this video, we're going to take a look at the top 4 tech stocks we're looking to buy the dip on if the market continues to fall. Basically, in this video, we're going to take a deep dive looking at some of the most popular tech stocks. We're going to look at their fundamentals, and we're going to see what points we would actually buy them at. So we have an awesome video today because I feel like a lot of people just blindly say buy the dip here or there with whatever stock, but it's so important to actually look at the fundamentals and understand what you're paying and what valuation these companies are actually trading at. So, Hunter, let's get right into it.
Yeah, so we're going to start with Apple. Everybody knows Apple, so they have a good revenue and net income growth, which is very important. They have good gross and net margins. They have extremely high free cash flow, like absurd. It's almost 1 year of their free cash flow is almost more than their entire long-term debt. So if there's a recession and a market crash, companies with tons of debt and they don't have like a lot of free cash flow to cover it, those are the ones that risk going under. So Apple really doesn't have any risk of that. Their free cash flow is also a lot more than the dividends that they pay out. Their retained earnings are dropping, but that's due to their huge share buyback program and the dividends that they pay. So it's not that concerning to me. I usually like to see retained earnings going up, but there is a reason for theirs, so that's fine. Their total assets are more than their total liabilities, and this is what I like to see on the shares outstanding. They're down a ton. So they're buying back shares, so you get more access to each like dollar of profit. Basically, like you have more access to the profit the company makes per share that you own over time with them buying back shares. So I really like Apple. I would like to get them at $85, but I would be willing to pay up a little bit more since it is Apple. So I would probably pay 100-ish for Apple, but they're just probably one of the biggest powerhouses in the world. So
Yeah, interesting. So I would say one of my favorite things about looking at Apple stock is how much shares they consistently buy back. Like, I feel like a lot of people overlook that type of data when it comes to investing, but it's so crucial because, like Hunter just said, let's say you have a company that, has, 100 million shares outstanding, but they buy back half their shares over the course of a couple of years or a decade or so. Like, you'll have access to double the profit than you did when you originally bought the shares. So, like, these buybacks are so beneficial to Apple shareholders, and it drives the stock up. On top of that, their revenue, their margins are amazing. They're continuing to innovate. They're one of the largest companies in the world. They do pay a small dividend, which, it's not like anything crazy, but, it's just another small perk of being an Apple shareholder. But while Apple's amazing, it doesn't mean that you pay any price for them. Kind of like what you just said, Hunter. So you're looking at like $100 or so. Do you have any other information in terms of like valuation metrics or any concerns? Like is there any obvious reason that you're not buying Apple at its current dip at like 139?
Well, two more things that I forgot to mention initially was how high the return on equity and return on assets are. The return on equity is 153% in the past year, which is just absurd. Yeah, when a company is this big, the growth can only be so high. Like, realistically, if you walk around, how many people have Apple products? It's so big already that it's not like they're going to be growing 15% a year and 20% a year. Obviously, they had that huge boost with COVID and stuff like that, but or the past year. So paying over 22, 25 like price to free cash flow or PE it seems high for a company that big. And back when Apple had way more growth potential years ago, they were trading at around like a 10 PE. So
Hmm.
it's not unreasonable to think that if we go into a bear market that the valuation metrics could contract all the way back down there, especially with
Yeah.
lower growth potential.
Right. Yeah, that's true. Because like when you look at it, like Apple's revenue from 2012 went from what is it like 156 billion, and then to 2021 up to 365 billion. Like that's amazing growth. But since since their revenue is already at 365 billion, it's going to be really hard to continue to grow at that same pace. You know what I mean? And like while you just said their return on equity is 153%, it's going to be hard to continuously get, those types of returns when you're as big as Apple is right now.
Yeah, and the only reason that I'd be willing to pay like a premium for them is because of who they are, and there's really, it's one of the companies that there's so close to a 0% chance it goes under during a recession, and it'd be like paying for safety sort of, even
Yeah.
though if there is a recession, people are going to slow down on buying very expensive tech products. So
Yeah. Yeah, I mean, at the end of the day, Apple is just such a powerhouse company. It's hard to ignore them. I was also looking at Apple around the $100 level, so we'll see what happens. They're a great company, but they'll definitely be on my radar.
yeah.
I'm also one not to be buying shares right now, but if it falls more, I will definitely consider it.
Yeah, I had shares that I sold, like, I don't know, a couple months ago. So,
Gotcha. All right, what's next on the list, Hunter? Nvidia?
sure, we can do Nvidia. Nvidia is and has been for a long time. I know I've talked to you about it months ago, how, like, I don't know, was it in December? How overpriced
Yeah.
Nvidia was. And I was like,
Yeah.
man, people buying this are going to get killed. That doesn't mean that it's not a very good company. It just means
Yeah.
that you need to pay the right price. And clearly, because it fell in half since then, but they have extremely high revenue growth, but it was shaky. Like it's been all over the place in the past few years. It could be from COVID, and the supply chain issues, making things pretty expensive. I know computers and the Bitcoin mining and stuff
Yeah.
has made Nvidia graphic cards just explode. So that's something to keep in mind, that those past few years might be outliers on growth potential. So,
Yeah.
but they do have very good revenue growth and high net income growth. Their gross margins are extremely high, like 65% is so high, and their net margins are also very good. Their free cash flow is growing, and it is also almost higher than their long-term debt 1 year. And I think Warren Buffett likes it to be like be able to have 5 years, between 4 and 5 years of free cash flow or net income to pay off their long-term debt. So if their long-term debt can be paid off within 4 or 5 years of their free cash flow, then it's pretty good, and they can do it in less than 2. They also do pay a little tiny dividend as well. So I guess it's a little bonus, and they can afford it easily. And the retained earnings, I like to see this, it's dropping a little bit, but that's not that big of a deal. It is higher than their total debt. So that I love to see. Their total assets are way higher than their total liabilities, and their weighted shares outstanding, they're increasing a little bit, but they've also decreased since 2017. So it's like,
Yeah.
I think that as they get bigger, they will end up buying back shares. So
Yeah.
I'm not too worried about them at this point issuing tons of shares. So
And then another thing too is like you don't want them to buy back shares when they're trading at, what were they at, like 300? You could say $346 each. Like if I was a shareholder of Nvidia, I would not want to see them doing buybacks during that time.
Yeah,
So
maybe.
that's another thing. And Nvidia, powerhouse company. I use a lot of their products. Obviously, like you said, the explosion with Bitcoin and cryptocurrencies, the mining of them really helped. It really helped with this Nvidia revenue explosion. Also, gaming over the past couple of years has been growing quite a bit. Artificial intelligence is on the rise, and that requires a lot of computing power. Everything, for the most part, uses semiconductors nowadays, so it's just like the industry overall is growing. They're a great company, they have great products, but you don't pay any price for them. So I was actually with you, and I actually had a short position on just like the semiconductor industry overall a couple months ago. It didn't work out too well because of the timing. Like it was running up so much. But yeah, I mean, I would definitely be willing to own Nvidia in the future. But there's no way I would pay the multiples that they're currently trading at.
Yeah, I was looking at, oh boy, around $60 to $70. Obviously, as time goes on, like if they don't get there or whatever, and their fundamentals increase, I mean that's gonna go up. As with any of these companies that we mentioned, those valuations will go up over time as their fundamentals get better. But
Yeah.
it's just not. It's ridiculously overpriced.
Yeah.
It's trading 53 times their free cash flow. Like that's just,
Yeah, and like they do have growth potential, but it's just like it's really hard to pay that type of valuation multiple, even though they're a great company, especially when we have other opportunities in the market now. Like it's one thing if Nvidia is trading at an insane valuation multiple, let's say back like a year ago or a year and a half ago, or even like 6 months ago when other stocks were really high and there weren't a ton of opportunities. But now that we saw, a lot of stocks, everything from Netflix to Facebook to almost every growth company, pull back in such a major way, then you kind of have to add in an opportunity cost with Nvidia too and other plays. Because it's like now there's just more opportunities out there, and you know what I mean? So it's just like, I don't know. It's definitely on my watch list.
yeah, and their increase in shares is coming from stock-based comp on the diluted shares outstanding, and they're not issuing new shares, but they are, I guess, technically through stock-based comp.
Yeah. So what prices are you looking to pay for Nvidia?
Between 60 and 70.
60 and 70.
Yeah, I said that in December too.
Yeah.
And it just needs to fall. I mean, they have a lot of growth potential, but then again, like you said, with the COVID forced people to be home. So many people bought PCs, whether it be for gaming or working from home. Mining for crypto was huge, and so it's like it's hard to judge what their revenue growth in the future could really be, and I'm not trying to get risky here,
Yeah.
Like there's so many companies to choose from. I'll just wait.
Yeah. Like I guess it'd be different if there weren't a ton of other great opportunities in the market. Then you might have to be a little bit less selective. But I know what you mean. I feel like a lot of people are gonna hear what you just said and be like, "Oh, Nvidia's never gonna get to 60 or 70," which might be true. But I think it's important for everyone to understand that, like Hunter, you're taking the approach more so that like you're not trying to swing on every stock. You're just trying to win on the stocks you do swing on.
Yeah, exactly. Like there's a disconnect between valuation and stock price, and at some point there will be a disconnect where the price is lower than the valuation, and that's just what you wait for.
Yep. All right. Interesting. What's the next one? Microsoft?
Yeah, we can do that. So.
Let's see. All right. How's it looking?
It looks good. This is one of my favorite. It's one of my favorite companies, just because of how good the fundamentals are. Their revenue and net income growth has been growing like crazy in the past 5 years. Also, Nvidia did have good return on equity and return on assets, and it's actually really similar to Microsoft's, which is also really high. Their gross margins and net margins are also insanely high. Like over 25% net margins is extremely good. And Microsoft has a bunch of cloud-based stuff, which has extremely high margins.
Yeah.
Their free cash flow is 1 year of it almost higher than their long-term debt, and they've been paying down their long-term debt. So that's good to see. It's also they can afford their dividend very easily, and this is also good. The retained earnings are increasing a lot and fast, and it's going to be higher than their total debt very soon. And retained earnings are similar to, you can do similar things that you can do with free cash flow. So if they were to reinvest in the company, and they can use retained earnings for any of that stuff. And their total assets are way higher than their total liabilities, and their shares outstanding are decreasing, which is good. So they're buying back some shares.
Yeah, I mean, Microsoft is like one of the perfect examples of what you want a company to look like in terms of fundamentals.
Yeah.
You know, like they're a powerhouse company. I mean, there's not too much I can critique Microsoft about. I like how they're trying to buy Activision. I know that Activision is trading at quite the difference from where it's set to be bought out at, which is, you know, conveying that the market is pricing in that deal has a decent chance of not going through. But at the end of the day, like, Microsoft is the powerful, influential company. They're a very smart company, in my opinion. But again, that just because you have a smart, powerful company doesn't mean you pay any price for it. So what price are you looking to buy Microsoft shares at?
Around 128.
128. Hunter.
I would.
Oh gosh.
I would be willing to pay a little bit more.
Yeah.
Just because it is Microsoft. And another thing is that with all these companies, since they're tech, they're not really in a dying industry. Like these companies are going to be around unless something horrific happens. like you can't replace Microsoft. Who's going to do it?
Yeah. Yeah, it would be basically impossible. You said like around 128. That's right around the COVID low. So I think we would need a really, really bad event to happen in the market to have Microsoft go all the way back down there. You know, I agree that its valuation is overvalued right now. It's definitely aggressive. I think there's a pretty low chance of Microsoft ever returning back to 128, but I guess we'll see what happens.
Yeah. Well, if we go into a recession, it'll be there.
Yeah.
Well, and if you look, it's trading 30 times free cash flow and 10 times sales. Those could easily be cut in half to be at market averages, but they have a higher growth potential and they have a higher moat, so they might knock it down there. But if you cut it in half, it's there.
Yeah.
So.
Yeah, interesting. Any other points or anything to know with Microsoft before we move on?
No, I don't think so. I think that's pretty good.
All right, and with the last one, we have Google that actually has a stock split coming up.
Yeah, I like Google. Google is also just like, this might have the best fundamentals like I've ever seen. It's very close to it. Their return on equity and return on assets are really high. Another thing I do like about Google is they have recently fallen a lot, so their valuation isn't as far off. Like, I could see this being very close to being justified where it's at right now. And another thing I like is that they do have that split coming up, and it's not because it changes anything about the company. I just like how shorting puts is going to be a lot more viable on them. At like $110 instead of 2,200. Their gross margins and net margins are also very high, over 25% net margins. So, and their free cash flow is over double their long-term debt. So there's 0% chance they go under, pretty much. And they don't pay dividends, so it doesn't even matter for that. Their retained earnings, look at this, like huge, huge growth, way more than their total debt. Like, if we are in a recession and there's a safe company, I just don't see how it's not this. Like,
Yeah.
it's so protected from their debt. Like, they have no issues with that at all.
Yeah.
Their total assets are way more than their total liabilities. And their weighted shares outstanding are trending down since 2017. And they announced a $70 billion share buyback, which I also am a fan of because they've fallen so much. And it is getting relatively cheap. Like, compared to Microsoft, their multiples are lower than Microsoft's. And they might have higher growth potential. I mean, there's so much to do
Yeah.
on Google. Like, Google has access to everything.
Yeah.
They have YouTube.
Yeah, they're a powerhouse. They truly are. They're one of the tech giants, as we all know. And what I feel like a big reason Google is less overvalued and less overhyped is because of how expensive the stock currently is. And I think that'll ultimately end up being an opportunity. Because, for example, over the past 2 years or so, we saw one of the quickest bull runs in history, right? For the most part, except for the beginning of this year. But basically, Apple, Microsoft, Nvidia, AMD, Tesla, and other ones were very hyped up because, well, there's a couple reasons, but it was easy for retail traders to just, buy stocks when, you have Apple at, $100 or, $130. Like, it's psychologically not that expensive, but less people rush into Google because the stock's trading for $2,600 per share. So I feel like there's less hype involved with that, which kind of presents an opportunity. So what prices are you looking at?
Yeah, they've grown way more than Microsoft in the past 10 years too, and their multiples are way lower. So I was looking at, I guess, post-split price, it'll be between like $75 and $80, which is 1,500-ish to 1,600-ish. But I could see maybe up to 1,800 pre-split, but I don't think that it would be bad here either. It's just, I don't know. I'd like to get it a little bit lower.
Gotcha.
And I think that once it splits, I'll just sell puts on it at those prices.
Yeah, gotcha. Interesting.
And this is all because of how bad the market is right now. Like, and it's not even that bad. Like, people think it's bad, but they only went through COVID, a lot of people, the COVID crash, which rebounded instantly.
Yeah.
It's been a long time since things have been bad.
Yeah.
Like 2-year-long downturns where it's just miserable.
Yeah.
And things get cheap, like dirt cheap.
Yeah. Interesting. So, yeah, I mean, I feel like we covered arguably the top 4 biggest tech stocks, or some of the biggest tech stocks in the market. Clearly, your buying points are a lot lower than the current prices that these companies are trading at. Do you have any final points you want to highlight to people? Because I'm sure a lot of people are going to think you're crazy with these price targets. So, anything else you want to mention?
Well, these price targets are based on, they're all what I would need to buy around those prices to get my required rate of return for the next 10 years. So they're all a little bit under what I think they're actually worth, because you need a margin of safety, because anything could happen, like recessions or all these guidance cuts. If you had done this last year and you had expected all this huge revenue growth and all these companies come in and cut their guidance, you just knocked off so much of the intrinsic value of the company. And that's why they're falling so hard. So when you're making assumptions for the future, you have to be conservative, and that's why they're going to be lower than. And it might seem absurd, but why said Nvidia was overvalued at 300, and people say I'm stupid, and now it's cut in half from that. So
Yeah.
things get cut in half all the time.
Interesting. All right, guys. Well, the market it has been very volatile and crazy over the past year. And the volatility, realistically, Hunter, it's probably just starting. Remember, volatility doesn't always equal downside movement. We can also see a lot of volatility to the upside. But realistically, the volatility is just starting. A lot of stocks are low right now, which is presenting an opportunity. And a lot of these big tech plays are less volatile relative to the growth plays. And when we do see these big powerhouse companies fall lower, it should present a great opportunity. So hopefully this video kind of, helped illustrate the importance of fundamental analysis and, why you shouldn't just pay any price for any investment. We use our stock analysis dashboard. That's what you see on the screen right now. It's an awesome tool. Hunter and I co-developed it together. You can see literally everything you could possibly need in terms of a company's fundamentals. We have a TA dashboard that allows you to compare stocks against each other, see if they're in an uptrend, downtrend, their correlation, and a bunch of cool stuff like that. On top of that, you can calculate your own price targets. So if you want to input your assumptions, you could do that. We have simple moving averages built into the platform. It's an awesome tool. You can cancel it anytime, and it will truly change your trading game if you use it in the right way. So fundamentals are so important, and all the data is here for you. You just have to use it. So check it out. The link is in the description down below. I use this every day, and so does Hunter. So check it out, and thank you guys so much for watching.